This is our Forex blog for December 13th, 2011. And like every day, we want to find the strongest currencies and buy them versus the weakest currencies. The real-time strength and weakness shows up here. Anytime you see green at and above the 80 level, it shows extreme strength. This is made up of 5 different of our statistical tools. 3 of them measure the direction, 2 of them measure the intensity of the direction, and underneath that we have the daily, weekly, monthly trend. So the dollar has the strongest weekly and monthly trend. Typically, if you see a lot of strength coming in and then less weakness, that strength's going to come back. But like nothing in life, and especially trading, works 100% of the time. So you might have got into a trade with here with a break even or a loss because that strength didn't continue in this instance. But then about an hour later, the strength resumed for about 40 minutes, a little bit of weakness. We had another 40 minutes of strength, 10 minutes of weakness, another 40 minutes of strength. So typically what happens is anytime you have a lot of momentum and then the counter trend trade has less weakness than strength, if it's in the direction of the daily, weekly, and monthly trend like you see here, usually that strength comes back. You can see it happened, yesterday throughout the day. A lot of strength, no weakness, strength came back. Very little weakness in comparison, strength came back, and so forth. But once a currency goes up too much, above or upper containment bands and so forth, it's up statistically too much, and it's much more likely to reverse. And that's probably what happened with the dollar today. But nonetheless, you want to look for signs that the weakness isn't that much and assume and predict that the strength will come back. And you might have a loss or two, but the key is small 5 to 12 pip losses and much bigger 15 to 30 and sometimes 1,500 pip wins. You can see a little bit of strength here, and then it went back to its primary trend, which is down. That's why we show multiple time frames. Everyone knows you should trade with the trend, but what trend? The real-time trend, as you can see, of the dollar's down, but the daily trend is still up, the weekly trend's very strong up, and the monthly trend's up. So, this is probably one of the hardest concepts for new traders, in knowing what time frame trend to trade. It might be going down for 3 or 4 hours, but if the daily, weekly, and monthly trend is up, if you look at a daily chart and you see it's going up, it's much safer to buy that currency at the lows than a currency that's extremely weak, like the euro right now. Buying the euro at the lows is probably going to result in massive losses, but buying dollar pairs near their lows is very likely to work because you're going in the direction of the trend. And there's a reason for the trend because traders are buying that and pushing it up. So if it goes down today like the dollar did, there's going to be some people coming in and buying it at a discount. It's highly valued. It's likely to go up. They're buying it at the lows. Whereas a currency that's weak, if it goes up and has some strength, you can sell them at the highs because you can see here the weakness comes back. So looking at the Australian, this is a pattern you typically find. Strength, less weakness, the strength is likely to resume. It does. Less weakness, strength resumes. This one barely has a weekly and monthly trend that was up, but later in the day it did. You certainly could trade the Australian against the weakest euro. Let's take a look at that one. This is not a currency I typically leave running. Weak euro, strong Australian, it's very likely to go down. You can see it did. So basically we only have 2 methods of entry. Once we spot a currency using the currency meter, we look for pullbacks, which this might be an example of one, or a multi-hour sideways rectangle. And the minimum for the rectangle pattern is 30 minutes. I prefer an hour to 2 hours, but in this case it went sideways from about 9:40 to 10:40. So it went sideways an hour and then it broke down. Let's look at some other currencies with the euro against the yen. Here you also have another sideways rectangle pattern. This one, the longer that it goes sideways, the more likely the breakout's going to lead to huge trends because traders are buying this here and stopping it from going down, and when it breaks down they're all losing money, and the longer it goes sideways the more people decide to buy, and when it breaks down there's more people in bigger positions that are losing and more selling coming in. You have breakout traders getting in new positions selling, and traders that are long have to get in out of their positions so that they don't lose even more money by selling, and all that selling causes, big moves. Let's look at, the dollar pairs and the yen pairs. The yen pair, a lot of strength here, followed by an hour of weakness, a little bit less weakness and strength. The longer term trend's up, so it's safe to assume that the strength will come back, and it does here at 5. At 5, the euro really wasn't that weak. Really, the pound was the one most likely to go down. Its weekly trend is just barely up. Its monthly trend is down. So you can still take trades. I prefer trades where the momentum matches the weekly trend, which is the middle one of our little colored strips. In this case, the weekly trend's just slightly up. It was strongly up, but because of this extreme multiple hour weakness here, it shifted just slightly up. But the monthly trend's down. Sometimes you don't get perfect trades. Currency's going up 3 or 4 days in a row, and then they pull back. The real-time weakness overshadows the weekly trend in some cases. So that for new traders might make it a little harder to trade. But the pound yen is very likely to go down coming up to 5 o'clock here. You have a lot of strength in the yen, a little bit of weakness. That strength is likely to resume itself. Usually you get anywhere from 30 minutes to 2 hours of weakness, and then the trend continues. Pound yen makes a good one at 5 o'clock to sell. Let me move this range chart out of the way here. Here's 5 o'clock. Notice this is the other of the 2 entry patterns I talked about, sideways rectangle patterns and pullbacks. Beautiful pullback right here. I like to either draw a trend line on the chart, or once you traded it a few hundred times, you can just visualize where the trend line is. Trend lines need to be broken by price, not by sideways actions right here. So as soon as it breaks the trend line and goes below that bar's low, you go short right here at 38, and you can see it kind of came down. It wasn't the weakest of all the currencies, and as it came down, notice it doesn't have a lot of intensity. It's not even hitting the 80 level, and then it kind of falls off a cliff right here, as you can see. You see that? Other pound pairs are not that weak, and therefore, the chances of this thing exploding through the lows is greatly reduced. But nonetheless, you could have been short somewhere around 35, and let's just say you get out here at 22 for about, after your spread, 9 or 10 pip win. You risk 10 or 11 pips to make 10 pips. It's not the best trade in the world, but the currency meter did allow you to spot a high probability trade. The euro, once you have this pattern here of some weakness followed by a lot less strength, 1 bar of intense strength doesn't really count. But for the most part, you can see not much strength right there. So coming up to 8, that was very likely to reverse down. The yen at that point didn't really look that strong, so you wouldn't have known that strength was going to come back in the yen. I prefer the dollar at that time. Had a little bit of strength after a few hours of weakness. The longer term trend is even stronger up than the yen is. And during that approach to 8, it didn't have the weakness that the yen had. So the euro dollar is an excellent one to be looking for sells coming up to 8. Here's our currency meter right here. And you can see, I'm not the currency meter, the euro dollar. This is a range chart that shows 6 pips per bar. When price is above the hourly, it's more likely to go up. When it's underneath the hourly, it's more likely to go down. Here's 8 o'clock right here. It's kind of going sideways. If you did go short when it broke down underneath this hourly right here, your first stop should have been above the bars right here. And you can see it's just kind of chopping around. The weakness that was there is kind of gone. So you always want to move your stop down. You would have lost, 5 or 6, maybe 8 pips in this. Came back up and then broke the hourly again. And the second entry is the one that led to a very huge win. You're short around 31.75. And even if you got out here where our trailing stop got you out, you made 50 pips. So one of the keys is trading is small losses, big wins. There's nothing complicated about the math behind trading. Forget about your winning percentage. That's for idiots and new traders. With our tools, some days the market's very easy and you're going to have a very high winning rate. Other days the market's going to chop around a lot. You might have a 5 pip loss, a break even, 12 pip loss, and then a win. But you took 4 trades in that case, and you only had 1 win out of 4 because you had 1 break even and 2 tiny losses. So your winning percentage is 25%. But if you catch a nice 50 pip win like this, you've made money. So don't be an idiot and forget about winning percentage. Focus on making pips because that's really the key to trading. It's the only secret of trading. Using our currency meter, you might get into a trade where the market goes sideways, and you had every opportunity to get out of this trade pretty much at break even, and it actually did go 10 pips your way. So you probably should have moved your stop down after it went sideways right here. Once it broke down, it should continue. We have a trend reversal signal right here. We also have the previous day's low right underneath here where it's likely to find some support at 63. So you probably would have got out of that trade with no more than a 5 or 6 pip loss because it did go 10 pips your way. You should have at least cut your stop, significantly. Let's look at some of the other possible trades we had. Again, the Australian, very strong today. The yen was weak. The Swiss is also weak. Daily, weekly, monthly trends down. It had quite a bit of strength right here. At this point, from 9, it has some weakness, followed by very little strength. At that point, you're looking to sell the Swiss. Now, what is one of the strongest ones coming up to 10 to buy the Swiss against? It's the yen. Because notice the dollar had quite a bit of weakness from 9.30 to 10, whereas the yen didn't. I would look for sells in the Swiss yen going up to 10. Would be the highest odds trade. It doesn't always work that way, but most of the time it does. Here's going up to 10. You can see that this trend was down. It rallied up here. If you had a tick-based chart or a range-based chart, you might have gone short a little bit above 83. But even if you waited for the breakout, or in this case breakdown, you're short somewhere here at 95, and you can see it went all the way down to 53. So it moved 40 pips your way. And that's why you want to read the currency meter. Trade the strongest versus the weak. If the dollar wasn't weaker here than the yen, you probably would have focused on the dollar because it has a stronger weekly and monthly trend. But focus, the currency meter makes it it provides a very easy to read roadmap. If you have two currencies like the dollar and yen that are both strong, trade the one that was less weak previously, and you're going to increase your winning percentage. And in this case, like you see here with the Swiss yen, catch more pips. You can also, because the euro was weak too, we already saw that, I believe. The euro yen also had a nice 2-hour breakout right here, and the euro yen, fell 70 pips. So you got 70 pips from one trade, about 50 in the other one, 120 pips just in a half an hour, using the currency meter. That can make up for a lot of, trades that you might take on your own, not using the currency meter that result in losses.